Hello, fellow Rebel Capitals. Hope you're well. I am back with someone that is a first time guest on the channel. I am super excited. Ed Dowd, welcome to the Rebel Capitalist Show.
Hey, thanks for having me on today. I appreciate you.
So, everyone knows who you are. I want to dive right in, topical discussion here, and ask your opinion on private credit and what's going on with Blue Owl. And you've been in this business a long time. And in your experience, how do these cycles typically play out? Is it usually a one-off, or are we just seeing more people swim naked as the tide goes out?
The cycle is different every time, but it rhymes.
Yeah.
Credit booms usually end. The last part of the credit boom is what Minsky calls the Ponzi finance part of the equation, where paper is issued, credit usually that requires neither cash flows to pay interest or pay principal down. It's all based on valuations continuing to rise. And so in the dot-com bubble, we had junk bonds financing CLEX and all these startups that had no revenues. They went out and bought a bunch of CapEx, and the big beneficiaries of that were the Ciscos and the Nortels and the Lucents of the world. And then they started vendor financing those companies, and then it all implodes on itself when the credit markets finally decide. They call into question the future cash flows, because it's all based on future cash flows and exponential growth. Never comes. Credit markets freeze, and then it unwinds. And the housing crisis, it was the subprime Ponzi part of the equation, just giving loans to people who could never pay it back. And the last 2 years, all the commercial loan growth from the banks has been to non-depository financial institutions, which is private credit and private equity. And I think the last 2 years of excess is coming home to roost, and we're starting to see it. I mean, it started off with First Brands last year, Tricolor Auto, and Prima Lend, and now we're seeing bigger and bigger issues. And this, you've been around. This starts a feedback loop, and then it's credit starts tightening everywhere. We have a housing market problem as well, in addition to this private credit issue, and some of the private credit is involved in multifamily structures, which is also was way overbuilt due to the alien invasion. We did the research on this, and we found that multifamily unit builds went beyond the peak in the 70s when the baby boomers were going to the workforce. So the alien invasion drove a lot of spec building and multifamily housing, and that's going to unwind.
Do you know Kenny McElroy?
I've heard the name.
He's a good buddy of mine in the multifamily space. He's Kiyosaki, Robert Kiyosaki's like rich dad advisor with the real estate stuff. Basically, Kiyosaki makes all the money and the books, and then he gives his money to Kenny, and Kenny invests it for him. That's where Robert makes the majority of his money. But Kenny's been in the multifamily space since like the late 80s, early 90s. And so he's got a front row seat. He's got his finger on the pulse, but he's very, very smart because he's lived through these cycles. And, what he was doing in 2021, 2022, and 2023 is not buying. He was just building dry powder. And he said so many people got over their skis because they just did these pro forma numbers, or they made investments on pro forma numbers as though rents would go up by 20% per year for the next 40 years. And so now what he's doing actually is he's buying stuff way, way, way under the cost of construction. A lot of these multifamilies that were built during that time period.
Yeah, and that's a smart move, and it's going to continue to unwind. And I'm sure he's very price sensitive. He doesn't buy anything that doesn't make any sense, because there's still a lot of people that are not realistic about where the pricing is, and so he's not touching those properties. But there's a lot of properties people are going to have ghost, and they're not
Yeah,
doing it yet.
I heard you talking on a podcast the other day about something that happens in these cycles very similar, and you were talking about it specifically with AI. So I think you mentioned railroads and then .com. It's a great technology, and it's absolutely going to be the future. But what happens is people invest way too much, the valuations go way too high, and then everything crumbles, and then people come in like Kenny and buy for 5 cents on the dollar, and now it's profitable, and then you go ahead and it takes us for the next, into the future. Can you kind of explain the research that you've done and how those cycles typically play out?
Yeah, it's the classic tech hype cycle. You know, Gartner consultants have analyzed the tech hype cycle. It's where there's this tremendous bullishness industry wide. CapEx floods the zone, but the revenues aren't there yet. The mass adoption is not there yet, and so eventually the credit markets revolt. There's a crash in these investments, and then people come in and scoop them up on the on the cheap. Happened with railroads, great technology, overbuilt, uh, crashed, burned. The first line of investors got wiped out. The second group came in, bottom up. Then the productivity started to happen for the U.S. over 5-10 years. .com, same thing. We had all this dark fiber build out. Revenues never came because the adoption hadn't started yet, and it crashed and burned. And then the beneficiaries of that were companies that bought that on the cheap. Apple was a beneficiary of cheap broadband. That's why smartphones took off. They couldn't have taken off, prior to 2000 because, telecom was too expensive. So AI right now is doing the same thing. We're building out all this infrastructure. We have all these competing AI engines, and they can't seem to make any money. And it's basically it's a commodity at this point. And it's a commodity, and you can switch between ChatGPT, Gemini, Perplexity, Grok. It doesn't matter. So they have no pricing power. Sam Altman is desperately seeking to raise more money. He's indicated that they're in trouble already. At the end of last year, he started asking for government bailouts on the financing side of things. So this is classic, and we're just going to watch it unfold. Nvidia at some point is going to miss a quarter because the capex is going to pause. And the gating factor used to be Nvidia chips. Now the gating factor is power, and there's a whole slew of issues around power, electricity prices, and revolts in states not wanting data centers built. So I think this capex that was all announced in the Q1 calls by Microsoft, Google, Facebook, Amazon, I think those numbers are going to be cut way back when we roll through time. And additionally, I don't know if you noticed, but last year when these companies would announce capex higher than expectations, their stocks were rewarded for that.
Yeah.
This earnings season, they were not.
Look at
Because
Nvidia. Didn't they report last night?
yeah, they did. It's down 5%. It was great
And they
numbers.
blew out earnings, right?
What's that?
And they blew out the numbers, but yet the stock's down, I don't know, 4 or 5%.
Yeah, they revealed in their 10K they have 95 billion in commitments to suppliers. That's TMSC, Taiwan Semiconductor. And what's interesting about that is, Taiwan Semiconductor is saying, hey, you want us to build out capacity for your demand. We're not going to do it on spec. We want purchase commitments. So TMSC is basically, telling us that they don't think this growth is going to be sustainable. So that they're trying to mitigate the risk.
Right.
And so, so the Taiwan Semiconductor is telling you all you need to know. They know this linear growth rate can't continue, and they're now demanding certainty.
Yeah, it's almost just to put things in or put things in terms that the average Joe can understand. It's like they're asking for more collateral. So if if they're taking your LTV from 50% up to or from 90% down to 50%, then you know that they're smelling smoke somewhere, and there's most likely going to be fire. Do you think there's systemic risk where we're talking about private credit? Do you think those balance sheets could be exposed to the AI bubble? And then you kind of get this feedback loop where as AI goes down, we get more problems in private credit, which makes money tighten even further at a time when they desperately need liquidity.
Join the Rebel Capitalist Pro community. Visit rebelcapitalistpro.com.
Yeah, look, we all know about financial reflexivity. When momentum is going on to the upside, it feeds on itself, it creates the narrative. Then eventually that momentum stops, it flips, and then the feedback loops start working the other way, and they continue until the bottom. I think we're in the beginning process of that. Spreads in private credit are definitely tight, widening. the feedback loops are already beginning. Definitely private credit is involved in the AI funding. I mean, there were a lot, and private equity as well. I mean, last year I was joking about debt being given to, these companies with NVIDIA chips as collateral, which it makes no sense to me. They're depreciating chips. They're, they'll be obsolete in 3 years, 2 years. So that, when I saw that the collateral was NVIDIA chips, I just was like, this is not going to end well.
Mm.
I mean, it's like Lucent and Nortel vendor financing their routers to these CLECs, using the routers as collateral basically. And so they ended up taking back a lot of these routers, but at, pennies on the dollar.
Yeah, I think the pushback that you get from bulls is this time it's different because you're referring to adoption, and the adoption for AI has just been, parabolic. I mean, how many users does OpenAI have? Like 2 billion? Like like 20% of the planet or something like that. But the issue here might not be adoption, but I would push back on the bulls and say it's the business model. It doesn't make any money. And I think you hit the nail on the head when you're talking about a commodity. And usually, I mean, I'm no expert, but just using common sense, you would think that their pricing power basically goes down to their energy cost plus 1%. And,
Yeah.
and that ain't a good business.
No, it's not a good business. And, yeah, so there may be adoption, but people aren't paying for the adoption. A lot of this stuff is free. I mean, I'm a premium member of X, and I get my Grok for free, basically. I mean, I'm not paying extra for Grok. Maybe that happens at some point, and, who knows whether I'll pay for it or not. But the real money comes from corporations, and they're doing pilots, and they're not really rolling it out in mass yet. And the same thing kind of happened with the .com. And everybody, during I remember, the late 2000s. The late 90s, early 2000s. Every company would announce an internet strategy, and it was just basically a PowerPoint slide presentation. And then it took years for them to actually roll out their internet strategy because there's a lot of logistics and compliance and legal issues and, flow work. And again, AI, when we see that, these comments that all white collar workers are going to be gone in 18 months, that's absurd. I mean, it's just absurd. They can't roll out the technology that quickly, and it won't happen. It's just, there's the hype, and then there's the real world.
Mm-hmm. So in the stage of this cycle, do you think it's more like the .com or more like the GFC, in the sense that, with GFC, sure, you get a recession, but it's more so a big credit event?
Yeah, it can morph into that because we got an AI bubble and a housing problem at the same time.
Yeah.
And then, a lot of people aren't talking about this, but China, we've done some deep research on China, and China's entering the acute phase of its real estate problems. They've been holding up their economy has been wobbling because of the real estate crisis, and they've bailed themselves out by exporting more, and that's why we have trade tariff wars. But right now, they're descending into an implosion in construction. Construction contracts aren't being renewed. There was a lot of long-lived projects that were keeping a lot of people employed. That's rolling over, and we're seeing signs of deep problems. One of which is net fixed investment in China. It's below zero for the first time ever, if you take out the COVID blip, which was temporary. So the year-over-year growth is going below zero. That's number one. And number two, electricity prices are going to electricity year-over-year growth output is going to cross below zero soon. So, those are two big signs that something bad's come from China.
How is copper trading above 5 then?
They're hoarding. That they have so much M2 money supply. They're hoarding. It could be for war, but it's definitely not going into industrial use. That's in the numbers. Their GDP last quarter was 4.5%. That's the worst quarter in 3 years. And there's a chance we might see a zero number on GDP sometime next year or two. But we'll see what happens. But it's definitely decelerating, and that has implications for their trading partners in Asia. Japan is the largest China is Japan's largest trading partner in both exports and imports, and also South Korea. So we got Asian contagion problems. We got deflationary pressures coming from Asia. We got an AI bubble, and we got a housing problem. So it's all coming to a head.
Yeah, and last time I checked, their long end, the rates are incredibly low. Weren't they almost all-time lows? And I'm talking about China.
Yeah, I know that China's bond market's predicting deflation.
Yeah.
And one of our biggest calls, is, we have the U.S. economic report. We think there's going to be a giant risk-off trade at some point this year, and we think one of the best performing asset classes will be long duration U.S. Treasuries, as it always happens in a down cycle. The long end is priced off of two things and two things only: growth expectations for the economy and inflation, both of which are going lower in our opinion.
Yeah. I, I laugh, Ed, because I don't know if you know my background, but I've never taken an econ class or a finance class, or I almost flunked out of high school. So I'm just completely self-taught, and I learned a lot, but I've learned so much over the past 5 years by doing, like, literally 2 to 3,000 whiteboard videos. And when you do a whiteboard video, you got to know what you're talking about. Like, you really got to know it. You can't just parrot a narrative. And in the course of doing all those whiteboard videos, it became abundantly clear to me that the long end of the curve is driven by growth and inflation expectations. I mean, you can just look at a chart of nominal GDP, for heaven's sakes. Go back 75 years and look at a chart of nominal GDP in the 10-year, and there's like an 85% correlation. But when I first got into macro, and I kind of bought the debt and deficit argument, hook, line, and sinker, because it makes so much sense, right? Like, if China and everyone's dumping treasuries, and the cent is going to issue, he's rolling over 10 trillion or whatever he's rolling over, you got the deficit, and where's all that demand? So you've got supply skyrocketing, we have demand plummeting. Well, interest rates can only do one thing, and that's go straight up. And then the Fed's got to come into yield curve control, and the dollar crashes. I mean, that was my viewpoint, prior to me really starting, and even at the beginning of the channel. But then I started to do all this research for the whiteboard videos, and it just became so obvious to me. So why do you think, mechanically speaking, it's all about growth and inflation expectations, and it has nothing to do, counterintuitively, by the way, nothing to do with debt and deficits? Because I think retail and so many of my viewers and people on social media, this really gets them confused.
Yeah, well, it comes down to a couple things: flow of funds. So what's going to happen when the growth expectations go down? People are going to sell everything with risk and go into bonds. That's just happened every cycle, and historically, there's the boom. The Fed raises interest rates, then there's a plateau, then they start lowering, then eventually there's a recession. I mean, if you look at the last 3 cycles, once they start cutting, it doesn't save the stock market, despite people thinking that. It may.
It saved the economy, by the way.
No, it doesn't, because there's a delay in monetary policy, and once investors start to realize growth is slowing, they eject equities and they buy bonds, and that's going to happen globally. And the dollar is not going to zero anytime soon. Somebody pointed out to me a long-term chart. When Japanese yields explode or go, have moves like this, it's usually very bullish for U.S. bonds eventually, because it indicates the end of the rate hike cycle. So this is going to be very interesting. And I had a hedge fund friend. I proposed this thesis last year, in the middle of last year. He laughed at me and said, "Oh, the debasement trade, yields are going to explode." And he's a smart guy. I got off the phone with him, and he's like, "I'm buying TLT. This is a disaster. I don't even think deficits matter." I mean, it's just 1/8, because if you're managing money and you start losing money in equities, you're not going to sit there and talk about the deficits. You don't care. You're going to go with what's starting to trend again. And the TLT chart looks great. It's if you look at the long-term technicals, it's the RSI is telling you that it's oversold, and it's going to go higher if we're right on our economic predictions. If we're wrong, we're wrong.
Yeah. The way I try to, the way I think about it and the way I try to explain it is it's about risk reward at the end of the day. And
Yeah,
especially with the banks in the Eurodollar system that in aggregate total, in my view, have basically an infinite balance sheet. They're not constrained by bank reserves or anything like that. And so they've got two options because they've got all these dollar liabilities. So they can't hold a lot of gold or something that's going to fluctuate dramatically relative to those dollar liabilities. So they've got two options. They can lend to the government or they can lend into the private sector. So if you see this cycle that we've been talking about with private credit and all these things, growth and inflation expectations decrease, now all of a sudden you can get 4%, let's say, on a 10-year treasury. That risk reward makes a lot more sense than taking that balance sheet capacity and lending into the real economy when you think there's going to be a lot of bankruptcies.
correct.
And then let's just say Basent comes out and issues 3 trillion tomorrow. Then what happens? Okay, you get a spike in interest rates, but if they like it at 4%, talk about the risk reward, they're going to love it at 5. And they're just gonna buy it down. And people, I think, get so confused because they look at the way they invest, because they invest their savings, and therefore the CPI really matters to them. But they have to understand that banks don't do that. Banks take pocket a spread between their borrowing costs and where they can buy. And if that spread, if they're paying on their dollar funding, let's say 2%, and they can get 5% on a treasury, they're going to do that all day long because their only other option is to lend into the real economy, and the risk reward there is extremely ugly. And that's, in my view, that's why you always see kind of the 10-year track with nominal GDP. Is that
Yeah,
been your experience or?
yeah, that's my experience, and absolutely, and of
Yeah,
course, it's getting. The job of a macro guy is to get these inflection points right.
yeah,
And what I think is going to happen is, after the worst bond bear market in the last 40 years. I mean, this was a devastating bond bear market after the Fed started going from 0 to 5.5%. I mean, bonds were awful. And then there was the risk on trade, the AI bubble, everything took off. Right now, if you look at asset allocators, everybody's on the wrong side of the trade right now. So
mhm,
when this starts to move, it's going to move fast, and there's going to be a scramble for government bonds at some point, and it's the 30 year is going to go up a lot very quickly, and the trade's going to be off to the races. And that inflection point's coming closer and closer. And you can look at the charts, and you can see the 10 years starting to wanting to go back below 4. The
yeah.
30 years caught a bid. We had a 30-year auction a couple of weeks ago that went very well. So there's a demand on the margin. Smart money's starting to figure this out.
What's interesting to me though is we're getting a bit of a flattener. Have you noticed that? It just look
Yeah,
like 2s and 10s. What's your view
yeah.
on that?
Well, normally what happens is after an inversion, we had the longest inversion ever,
Yeah,
and then we tried to normalize at the beginning of last year, but then we flattened again, and then we started normalizing again, and that's definitely a indication of a recession coming. Because once you uninvert and normalize, that's
yeah,
when the recession is here. So
yeah.
I don't know what's going on in the short term technically, but I'm convinced we're going to see some interest rate Fed cuts coming in the next 6 months, and they're going to come because they're going to be surprises to the downside.
You don't think they're gonna hike it?
No, I don't think they're going to.
I
You know,
I
you know,
when
you,
he
you,
came out
you-
with that report, I was like, "Come on, come on."
what's that?
When they came out with the minutes or what the
Oh yeah,
Fed had
that
to
that,
say.
that they don't even know what they're talking about, and I think
Yeah.
that's political. Honestly, I think that's political to stick a thumb in Trump's eye. Um,
Okay.
and we're gonna get interest rate cuts, but not because things are going well. That the cuts are going to come because things are surprising to the downside. And look, let's talk about non-farm payrolls. I mean, those numbers are a joke. Statistically, at this point, they're garbage. We can't even look at them and make any sense to them. They were wrong to the tune of 4 standard deviations to the upside, meaning that they overreported jobs in 24 and 8 standard deviations in 25. So, what's going on there? It's either bureaucratic incompetence, fraud, combination of the two, or it's a national security issue. I can't. I don't know. It doesn't matter. The numbers are garbage.
Yeah. So as an asset allocator, how do you get a read on the labor market? Because I think I say on my channel all the time, I think that's the most important thing that you've got to focus on, because when that thing goes, usually that's kind of what I call the Biden moment, right? Now, I don't know if you remember, everyone leading up to that debate in the mainstream media was trying to tell us that Biden is as sharp as a tack, right? Oh no, he's never been sharper. Like, come on, anyone see him shaking hands with air, and everyone on social media is like, you got to be kidding. They're calling you a conspiracy theorist. But then when they had that debate, it just becomes so obvious, the Biden moment, that even the mainstream media couldn't keep up the ruse anymore. So I guess that's kind of my thought. And the question is, when do you think we have that Biden moment in markets? And not just with bonds, but also with stocks too, because stocks, I think it's a little bit different equation because of the passive bid. And that's such a tailwind until the unemployment rate gets up to, 6 or 7%.
Yeah, so you get the passive bid, but we're starting to see demographic declines in the boomers. So that's going to flip at some point. And also, the Mag 7 are not going to be doing stock repurchases with all the cash flow problems that they're having.
All right, right.
Yeah, so their capex is going to chew up their stock repurchase program. So that is also a problem. And if earnings start to go down, which they will at some point, the passive bid will evaporate quickly on the margin. So look, I think you just nailed it when you said it's a Biden moment. And when we started figuring out the jobs numbers were garbage last year, we were one of the first people to come out and say, they're garbage. I mean, they're just wrong.
How did you come to that conclusion, though, Ed? And what do you do now? If you could explain that in your answer.
Well, basically, we looked at the quarterly census of earning and wages, which is reality. Okay, that's a report that's done in arrears. And by the way, in my career, none of us ever cared about that report because it was just like a book report, right?
Right.
Because the non-farm payroll used to, pretty approximately, mirror that, and was, it was off a little bit, standard error, which was acceptable, not 8 standard deviations. So we never knew what that report was, but then we started to notice that the reality was, that's why we were constantly seeing revisions going down in 24, 23 and 24, they were quietly revised. And they were doing that because the QCEW was coming in. And then once we figured out what that was, we looked at it and, we realized that reality was way different from what they were estimating. And so we had the same discussions internally, like, when is the Biden moment coming to the capital markets? Because the capital markets have been acting as if job growth's been fine the last 2 years.
Yeah. Yeah.
And exactly. So at some point, and I think, if you wanted to, put your finger on when the 10-year and the 30-year started to rally most recently, it was when we had the jobs report and the revisions. So it's starting to dawn on the capital markets. Maybe something is awry. And I don't know when that moment happens, but when it happens, because everyone's on the wrong side of the trade, this could be very fast. And volatility and speed kills in markets with margin. So there's a chance this could be one of the fastest unwinds ever. I think that's a 65% chance. The other probability is that it's slow, like the .com bubble, and everything kind of unwinds over 2 years. But this could be fast, Jordan.
Do you think it's just like a negative GDP print? Because, like, the bears just always, me included, just point to the labor market all the time. But then the bulls just ignore the labor market and just point to GDP. And like 4.3 revised up to 4.4. Sure, we got what was the last one? 2 point, or no, it surprised on the downside to 1.4 or something like that. But they kind of, that's just noise. So do you think we just need a couple quarters of negative GDP along with a further deterioration in the labor market, a few negative non-farm payrolls like headline, and then that's the Biden moment?
No, I think it's going to happen before that because, if you remember during the great financial crisis, they didn't, they called a recession in arrears when it actually started, and it just started in
Okay.
December. Yeah. And so, we could be in recession right now. I think we might be. And what's going to happen is the equity markets and the bond markets are going to start doing their thing on their own. And the feedback loops are beginning, and we see liquidity is becoming a problem. Bitcoin is telling us liquidity is a problem because that's just, that's the early indicator of liquidity. We're seeing the private credit markets freeze. Eventually, it'll work its way into equities and margin accounts, and that's how it goes.
Right. Yeah. So I just want to, just for the audience there, the NBER, I believe they just announced officially there was a recession in December of '08. And they said, yeah, it started a year ago. And
Yeah,
so I think that they're going to do something that's similar and they're just going to revise down GDP.
yeah, correct. And let's look at the most recent GDP. I mean, I was hearing from the bulls and the administration that it was going to be 4.5%.
Oh, Lutnick was, it's going to be 7 or 8, Ed.
And then we came in at 1.4, and personal income was abysmal. So,
Hmm.
look, if you really want to know what's going on, look at personal income, and it's not going anywhere. And that's eventually, where the economy goes. And, layoffs are starting to accelerate. This is a really tough job market. The job market hasn't been growing. I think it's been determined we added 15,000 jobs a month rather than you know, the 150 they were touting. I mean, it's
Yeah.
crazy.
How do you think about initial claims?
I don't pay attention to them anymore, but someone did a good analysis suggesting that the labor market structure has changed. And there's a lot of, I think, 1099 people, so that, like, it doesn't show up.
Hmm.
I mean, there's ways that it's not as useful as it used to be because the labor market's shifted.
Yeah, Mike Green, a good buddy of mine. I'm sure you probably know Mike.
Yeah.
He always points at the gig economy as maybe an explanation.
Yeah, I think that has a lot to do with it. I mean, a lot of people are, have side hustles or
Yeah.
double side hustles. I mean, I live on Maui, and the average person is struggling mightily.
Yeah, I mean, I see it in the comments. I see it in the people that I talk to almost on a daily basis. Going back to the difference between the GFC and the dot-com bust, I think what could be slightly different, and it's concerning to me, is that I remember those extremely well. And I remember back then, the economy wasn't, in my view, wasn't nearly as dependent upon asset prices as it is now. I live in Colombia, in Medellin, and I always joke that if the Colombian stock market went down by 50% in one day, I don't even know if it'd make the news here because nobody cares about the stock market because no Colombian has any money in the stock market. They just put it all into real estate. And I just think about .com, those times back in the late 90s, and I just don't remember the economy being as dependent on those asset prices. Therefore, you get kind of a mild recession. But now my view is it's the complete opposite, where the entire economy is basically propped up by asset prices and AI CapEx spend. So how do you view that?
Unfortunately, I agree with you that this is the problem. We've become a financialized, hollowed out economy.
Right,
And
right, right.
let's talk about something that could happen. It might happen, but currently, we have a housing market that's dead. There's pending home sales are at their lowest. The boomers who are, on 1/3 of the real estate, sitting on 1/3 of the real estate, aren't lowering prices. The millennials and the Gen Z aren't buying because of affordability issues. So what could trigger home prices cascading very fast as opposed to the glacial slide we see now?
Yeah, the
Well,
unemployment rate going up.
what's that?
The unemployment rate going up. So
Well,
where people
that, but also if the stock market starts to decelerate and goes down quickly, the boomers are sitting on fat gains in their stock portfolios. So they're feeling, that's why they're not probably pulling the trigger on lowering the prices on their real estate. We could see a whole different regime if they lose 40% in their stock portfolios. They could start having a mad scramble. Let's lower prices fast to get rid of this piece of property I've been trying to sell for 2 years. So that
Um,
so
my-
these feedback loops could get really bad really quick.
That's a good one. I hadn't thought about that. You've got two forms of retirement there. If you're a boomer, you've got your home equity and you've got your 401k. So if your 401k takes a hit really quick, 20-30%, you're like, shoot, the only thing I got left to secure my retirement is the home equity. Let's unload this thing fast and then downsize before, while I can, type thing. And everyone's running toward the exit in the movie theater.
Right. And then of course, as prices roll down quickly, bank balance sheets will be called into question, and the feedback loops begin, just like the GFC.
Yeah.
Remember, speed kills in these equations. The faster it happens, the worse it is.
Yeah. And it's
But
always,
the good news is it ends sooner. There's a lot of devastation, and then you get a chance to recover a lot quicker. So, it'll be brutal if it's quick, and that might cause systemic issues. We don't know. In our reports, we're not calling for a systemic bank failure issue, but if we start seeing it develop, we'll call it out.
Yeah. How do you play the long end thesis?
It's simply just if you're an individual, if you're an individual investor and you don't want to take interest rate risk, and you want to protect some of your stock portfolio gains, raise some cash in your portfolio. We call it dry powder and buy bargains. Now, if you're a more speculative or an institutional investor, you buy 10s, 20s, and 30s.
Okay. So retail, just buy T-bills.
Yeah.
And institutional, maybe buy the long end.
Yeah, correct. I don't like to get retail involved in interest rates.
Yeah, right. What do you think about the Steepner deal? I don't know if that's the correct way to phrase it, but I've had that on, and I've done decent with it, but there's kind of I've noticed there's a negative carry on that. What I'm talking about is just buying 2-year futures and selling 10-year, and then just play the delta. I know that's probably not for retail, but just you personally, what do you think of that?
Well, I think we're going to get a really a nice bull steepener, which in fixed income land is not, good for the economy. It's good for fixed income investors. It's not good for the economy. What it means is short-term rates are going to go down a lot faster than long-term rates initially, and as emergencies start to emerge. But the long end will do well on price appreciation, but the short end will go down quicker. That's kind of what I think is going to happen. I think we're going to get some very swift rate cuts sometime in the next 12 months, and then the long end will eventually respond, and then we'll get a nice steep yield curve, because that predicts the recovery down out in the future.
Right, and then you get the bear steepener. So you get the bull steepener followed by the bear steepener, and that's usually why you go in these cycles from inversion to a positive 250 basis points.
Correct.
Yeah. So in your research, how does the long end, as far as the timing, typically play out in these cycles? So to be more specific for the viewers, in 2008, as an example, if I'm not mistaken, the 10-year treasury from March to, call it, July of 2008 went up by like 100 basis points, because the CPI, most people forget, the CPI in late 2007, when they started cutting, was roughly 3.5 or so. And then by summer of 2008, it went up to like 5.6. You had the CPI go up like 200 basis points. And everyone thought the Fed was way off sides and that they'd be starting a rate hiking cycle. And I know this because I always go back and read the archives from the Wall Street Journal to see the print, when they actually release the CPI number the next day. So, and then of course, when the stuff really hits the fan and the Fed drops from wherever they were, 2.5, straight down to 0, then you really get that drop in the long end. But it took a long time to really play out. Do you know what happened in the dot-com cycle, and how do you see it playing out this time?
Well, let's talk about the great financial crisis. I remember that quite well. Um, and I was at BlackRock, and there was lots of debates about where, people were calling the bottom in home prices, in '07 and at the beginning of '08. This is it. This is
Even internally?
Yeah, eternally. There was,
Wow.
Larry Fink called the bottom in '07. Um, then he did some ginormous deal with New York real estate. I forget the deal, and it was a huge bust. But
Mm.
um, what was going on was we had the commodity China story and oil, and we had peak oil.
Yeah.
Oil went to like
Rip.
180 bucks or something crazy, 160, something crazy. Um,
During
and
'08, guys, what he's I just
in
want
'08,
yeah.
it peaked in June of '08. And going into the great financial crisis, we had CPI prints that were incredible. They were accelerating
Yep.
until they fell off a cliff. If you look at what's been happening this time, we've kind of had a similar situation that the 10-year tried to go down last year, 30-year tried to go down. Then we had some reacceleration, and then some inflation scares, and oil went up a little bit because of some Iran issues, and and what usually happens is the the consumer just eventually taps out, and then the credit contraction begins, and that's when things just come to a screeching halt. And the dot-com time frame, it wasn't so much a consumer led recession as it was a capex led recession in the dot-com boom. And the consumer kind of did okay. Then real estate, they printed a ton of money, and then real estate took off. So it wasn't, you know, you could say that they basically were worried about deflation to the point of inflating a real estate bubble in the early 2000s, which is exactly what they did.
Yeah. Yeah, but unfortunately, now we got the CapEx bubble
Yeah.
and we've got everything else. Like all
I,
this.
I, I think if you're looking at inflation, it's trending down. There's a service called Trueflation which tracks real time inflation. And I'm not saying that the numbers are correct, but what I think they're good at is showing inflection points, and they're showing a huge decrease recently. So they're seeing an inflection point coming, and a timing. And I think we're going to see a sub 2% print at some point this year, maybe a sub 1% briefly, before the Fed loses its mind and starts printing like, jackrabbits.
On the headline CPI alert.
Yeah, on the headline CPI, yeah.
Mm.
And 36% of the headline CPI is shelter, and rents are rolling over hard. And that eventually feeds into all tenant rents, which is a calculation, and then feeds into home prices. And right now it's cheaper to rent a house nationally than it is to buy a home, and that doesn't last long. So the home prices are coming down. If you had asked me one thing, I'm pretty sure of, home prices are going lower. It just, there's no way they halt the descent in the home prices.
Just nationally in nominal terms lower.
Yes, correct. In nominal.
Hmm.
In real terms, they started rolling over, and in Europe as well. People don't get this. There's kind of an international housing problem. They're rolling over in real terms, then nominal comes next.
Yeah. So let's switch it up a little bit here. What's your view on Japan? Because you were talking earlier about how the interplay between Japan and China, and that China's kind of in the eye of their GFC, their real estate massive bubble unwind. But yet you've got the Nikkei going to seem like all-time highs every single day. So how do you look at that? I guess that's the question, really, the Nikkei going up, Japan, and what's happening with China and their exports.
Well, look, the stock market will do what it's going to do until it doesn't. And what I do know is that Japan is going to Hobbesian decision. They can either save their own economy and tamp down inflation by raising rates, or destroy the yen carry trade, which is there's still a lot of those assets that haven't been sold yet. So they have a tough decision. And Secretary Bessent and the Fed have a lot of influence over Japan. And I think they're very cautious about what's going on in that situation. I think once the global recession becomes apparent, especially once the U.S. It becomes apparent and assets start moving, I think the Nikkei is going to get slaughtered. I think global growth is expectations will drop, and everybody's going to start lowering interest rates again.
Hmm. What do you think about the argument with the long end that like the 30, 40-year interest rate cycles?
Well, so I think once we get this recession out of the way, the long end will come down. But I do think we may be going into a different rate regime long term.
Yeah, right.
Meaning they went like this, they went up, they're going to go down again, but then we're gonna see this kind of thing for years back the other way.
Higher lows.
Yeah. But people always straight line and say, oh, and yields are destined to go higher, and the debasement trade, and they're all on the wrong side of the trade into the teeth of a recession. And the trick is get into the long end if you're an institutional investor. Then when the bargains come up, get out of the long end and go back into risk assets, because they're going to inflate the hell out of this again.
Yeah, yeah, yeah.
So
People,
it's a trade for about a year or two, and then you want to reverse it.
yeah, I totally agree. I totally agree. I like commodities longer term. I mean, talk about a super cycle, but just going into the teeth of an economic slowdown, especially globally, what's happening with China, it's tough to be super bullish on commodities in the short term. Although long term, I am. So it's just you keep your dry powder, and you wait till the stuff gets cheap, and you wait till you get the reinflation, coming out the other end, and you get that bear steepener, and that's when you want to go into commodities. That's kind of how I look at it.
I agree with you. Commodities will be great once we get through this, but I wouldn't be there now, because they're gonna get pummeled.
Yeah. What do you think of the precious metals? And just, I mean, obviously that's topical based on what's happened recently.
Yeah. So precious metals, you know, uh, let's talk about what happened during the Great Financial Crisis.
Yeah.
They bottomed in gold bottomed in 0001, I think, and then went on a bull run because somebody somewhere started to watch what the Fed was doing and anticipate this is going to be a credit disaster. So gold was anticipating some credit disaster and took off into the great financial crisis. But in the panic, it went down 50%, because you sell what you can, not what you want, and
Mhm.
and so a lot of people got wiped out if they bought gold at the top. But then it did recover faster than the stock markets and went to new all-time highs. So I think this time around, if there is a panic, gold and silver may get hit, but I don't think they're going to get as hit as badly as they did in the Great Financial Crisis. And I think long term, given what's going on globally with the debt problems and the demographic problems, I think gold and silver, which are again no one else's liability, and mistrust of sovereign debt, I think long term they're great. And the charts, when you look at the chart of gold, it looks like it wants to go to 10,000 by 2030. Silver, uh, silver may take a hit in any kind of recession because it's an industrial metal, but I think long term it's going to go over 100.
Yeah. I don't, I'm bullish as well, longer term, not so much because of the debt and the deficits globally, because I just, going back to our earlier conversation and looking at a chart, I can't see when that's really played a role in the strong correlation with the price of gold. But I do think the counterparty risk, that's something that's
Yeah.
very, very real. And in my view, that's one of the main reasons why you had the big run in gold was central banks absolutely buying gold and selling treasuries. I don't think that impacts the yields, but I do think that impacts the price of gold. And if that has been the major driver of the price going to, let's just say 5,000, 5,300, wherever we are today, I asked myself, is that going to slow down moving forward? Like especially with the geopolitical risk and the bifurcation of the global economy, all these things you could point at, and you ask yourself, are central banks going to stop buying gold or buy a lot less? And I think the answer is no.
No, I agree. So we got central bank buying. We got commercial banks now buying, because in the US, they made it tier one capital. So
Mm.
physical gold can be, you can create money from it now. So that matters. Then we also have tremendous retail demand and institutional demand and central banking demand from China. China is in the process of, to keep their economy going and their exports going, and basically they're depreciating their currency massively. So there's internal demand for gold in China. And then India, of course, is always, buying gold. Everybody there buys gold. And I think gold, demographically, we're declining, but the currencies are declining faster. So there's going to be huge demand for gold, is my humble.
Yeah, the problem is, I mean, going to 10,000, does it do it in real terms or nominal terms? You know what I mean?
Yeah, I hear you. And, the question is, how fast is it? The faster it happens, the scarier it is for all of us.
And
I'd rather see it slowly creep to 10,000 over the next 4.5 years rather than go to 10,000 next year. That would scare.
yeah. Do you look at the miners?
We haven't looked at the miners. We're more macro. We don't get into stock specific issues, but I think they've had a nice bull run. If there is a general stock market sell off, they'll probably relatively outperform, but they'll go down if there is a 40 to 50% haircut in the markets.
Yeah. How did you guys look at the Fed's balance sheet in terms of liquidity internally? Did you guys think, I'm talking like all you guys had the same opinion or something, but did you guys see that as a major driver of liquidity, or not so much? Because at the end of the day, the banks are going to create the majority of liquidity in the global, let's just say, monetary system or financial system. And although they can use bank reserves for settle, they don't have to have them. How did you guys see that as
Well,
far as, go ahead.
yeah, so we were, M2 grew massively, uh, you know, after the COVID experience, and then
Yeah.
rolled over, and year-over-year growth went negative in 23, which hadn't happened since the 30s.
Yeah.
And that was and then we had some bank failures. Now, people claim the Fed money printed. They did not. They just loaned banks money, so there wouldn't be a bank run on their, interest rate sensitive underwater assets, which were held to maturity. So that was like a stop. That wasn't money printing. But then we saw M2 start to take off again. M2 was basically growing, not because the Fed was printing, but because the banks were lending to non-depository finance. It's the last
Private
2
credit.
years, private credit and private equity. So that was the money, that was the liquidity that was pumping into the markets, not the Fed printing money. That's a misnomer. Overnight repos are not money printing. There's this, when I see these things on X, they're printing 14 billion into no, well, it's overnight lending. And I was a bond salesman. I did overnight repos first 5 years of my life in business.
Yeah. So I guess the punchline there is, when you were working on Wall Street, or let's just say, you were an insider, it was pretty much known that how the financial plumbing works as far as how you see it today? Or were there some guys that you were working with that were just completely clueless?
Most people are completely clueless as to how the financial plumbing works. I mean,
Even the guys you worked with?
yeah, I mean,
Wow.
they were just traders. They thought in making money in their P&L that day.
Mm.
Lacey Hunt worked with me. He understood, but he was the economist for HSBC, and he could explain it. But the trader, most people in Wall Street are in their silos. They just want to make money. They don't care about how any of the stuff works. They're very siloed. And that's why, if you can understand, I started off in credit as a bond salesman. Then I went to equities. When I was in equities, I always understood credit, and I was able to, I was a tech analyst at Independence Investments, but with my fixed income experience, I started analyzing. I was a tech analyst. I started analyzing the balance sheets of Lucid and Nortel, and I said, "Hey guys, we got problems. They got negative free cash flow, and they just grew 50% revenues year over year. I think this is not going to end well." And sure enough, that's because I'm a fixed, I'm a more conservative than most equity guys, and then I became a growth manager, and I always was looking for when to get out of stocks, not just to ride them over the cliff. And
Mm.
credit tells you when to get out. Credit is always the early warning sign.
Yeah, what we're trying to say there, guys, is if you understand how this stuff works, it's not just esoteric. It's actionable, and it's an edge. if you know what you're looking at. So on that bombshell, Ed, to get more of an edge, how can people follow you and how can people find out more about what you do?
Yeah, so we sell our economic research at financetechnologies.com with the PH instead of an F. Um, I'm on X at Dowd Edward. I post a lot. And I also have a private website, eddowd.com. And I can be found at all three. And I think if you're an institutional investor, you should definitely check out our China report and our U.S. economy report. If you're a retail investor, it might be a little pricey for you.
Okay. Sounds good. Thanks for your time. Really enjoyed the conversation, and I'm sure we'll do it again. Can't wait.
Absolutely. Thanks for having me on.